Let's just welcome in Manishi Raychaudhuri, who's with us with just what he's making of things here. Manishi, good morning. Great to have you with us on the program. I think the big talking point, of course, is the big surge in oil. No one knows how this kind of goes. If history is any suggestion, it's short-lived. The spikes are short-lived, even if they are sharp. So I guess you just got to go with that. If the Strait of Hormuz, as we were discussing, is closed, then no one knows what will happen. But what's your sense? How do you assess risk-reward from here for markets broadly?
What's happening today, the reason for that is obvious. I mean, we've pretty much all Asian or emerging markets down anywhere between 0.7 to 1.2%. And it's a direct fallout of the increasing geopolitical tensions in the Middle East and the consequent increase, the spike in oil prices. Now, one doesn't know how long this tension would continue. One can only hope that the military tensions die down or are resolved, pretty soon. But, honestly, these things are completely unpredictable. So in the near term, we obviously will have to tighten our belts, brace for more volatility, but that's the only thing I guess one can say from a fundamental perspective. If you look at the longer term, once these military tensions are behind us, then emerging markets and in particular Asia have a lot going for them. There are quite a few tailwinds that have aligned together. We have seen the US dollar weakening, and that's actually likely to continue for some more time. And as a consequence, we are seeing the Asian central banks getting a much higher degree of confidence in injecting monetary stimuli through rate cuts and reserve ratio cuts. The most recent example is the RBI, which actually front-loaded these actions. So, we have quite a few things going in favor of Asia. The only thing that I think still needs to fall in place is an earnings estimate recovery, which was beginning to happen for a brief while in late 24 and early 25. But the earnings estimates are coming down again, except for, I think, a few markets like Korea and Taiwan. We have seen earnings estimates decline, and that's true of India as well. So I think we need that earnings picture to stabilize. Hopefully that'll happen once the impact of these monetary stimuli hit consumption and investments, possibly in the second half or maybe in the last quarter of this calendar year. But till then, we will have to be prepared for a range-bound movement of equities in this region.
So markets are range-bound. Manishi, hi, Rima here. So how are you positioning yourself now in the Indian market? Take us through your portfolio and your big bets.
Right. So we have an Asia ex-Japan model portfolio, which we recommend to clients. And we actually have an overweight stance on India on that. So compared to a benchmark weight of close to 20% for India and MSCI Asia ex-Japan, we have somewhere around 23 to 24%. The largest weights in that portfolio are the private banks. I have been harping on the private banks for quite some time now, and that stance hasn't changed. I mean, if we're going to have growth in investments and consumption, that'll have to be financed largely by the private banks, which are gaining in terms of market share. Second, we do have consumer discretionaries. And that's a combination of both automobiles, particularly four-wheelers, and some of the higher-end premium consumption, like jewelry. I would also add some of the tourism-related names to that bucket. Third, we have some exposure to the IT services that's more tactical than strategic. We think that the valuations are now in favor of investors. And if we do have, the US corporate performance turning better, particularly for banks and, the other for service sector, that would have a positive tailwind for Indian IT service companies. So these are some of the, the important exposures that we have. We also have some exposure to telecom, petrochemicals, the conglomerates that you can think of. I'm not going into any names, but it should be obvious. So that is really our India exposure in our portfolio.
Hi, Manishi. Good morning. Good to see you again. It's a bit of a subdued start to trade, both for the markets globally as well as emotionally. But, at times like this, when you have geopolitical tensions that rev up yet again, it provides opportunities at times. And one sector of the market that's been getting a lot of attention is the defense space. Some of those valuations have gone, out of whack. While there's a counter argument that there's going to be increased focus, increased spending on the defense side of things. So these companies ultimately, the earnings will catch up to these prices. What's your view on it?
So defense sector is something we like. In fact, in response to Rima's question earlier, there's one sector that I did not mention is industrials, where we do have significant exposure in our portfolio, and that includes, some of the dedicated defense names. The problem in the sector is valuations, because a lot of significant growth expectations going forward have already been factored into the prices. So, even if those lofty expectations are realized, and I'm not saying that they won't be, but even if they are realized, the valuations may not really move much higher. In fact, we may have some kind of a plateauing of the valuations and share prices for a while. I would not expect these stocks to decline significantly on an absolute basis. But what you may see is, what's called a time correction in this sector. So investors would have to be a bit careful in terms of valuations when adjusted for future earnings growth when picking stocks in this sector.
You said India's weightage is 23% versus a benchmark weight of 20% in your portfolio right now. What's the most in terms of, India's, what's the maximum that you're willing to go? Is there more headroom for you to up your exposure to India?
Right. Now, that's an interesting question. I think that willingness would come once the headline valuations, particularly the relative valuations of India, narrow down a bit. This was actually the situation sometime in March. Indian valuations peaked out in September, then for about 6 months, they drifted downwards, while North Asian valuations, the North Asian markets outperformed India. But since then, we have had another spike in Indian markets, Indian valuations. So that relative valuation gap, which had narrowed down, has opened up again. Now, of course, I think over the last 1 week or so, we are seeing another round of pullback in India. And simultaneously, there are some North Asian markets like Korea, which have spiked strongly. So I'm hopeful that that relative valuation gap may narrow down again, possibly in the second half of this year. But, India's valuation premium to Asia, which is somewhere between 35 to 40%, that's the long-term average, it would really needs to come down there. Currently, it's somewhere around 50 to 52%.
Got that. 50 to 52% is India's valuation premium. So you laid out some sectors that you like. Large private banks, you've always been bullish on that. Some consumer discretionary, which includes jewelry. Some, I think, tourism names, industrials, which has defensive, and a tactical bet on IT. At this juncture, if you have to put incremental money to work, which sector would you buy right now?
One easy way of responding to that is, buy more of, what we already have, or buy more stocks in the same sectors where we are exposed. But there's one sector, if I were to look at the sectors that we don't have exposure to, which we are avoiding at this point of time, the most prominent one is consumer staples, where we clearly think that the valuations are not in favor of investors when one looks at the future earnings growth. We also don't have metals and mining, but that is something one has to look at carefully, because I think some of the some of the metals and mining exposures, particularly say in copper, could actually do better if we do have kind of a broad-based improvement in infrastructure investments. Copper is one of the biggest barometers of that. But broadly, I think our sectoral allocations would remain unchanged, even if we were to sort of allocate more to the Indian pie.
Point taken, Manishi. Thank you very much for joining us. It's a pleasure having you here on CNBC TV18. Good sort of contextual regional commentary with, of course, India at the center of it.